The Federal Reserve recently released minutes and Jackson Hole Symposium comments suggest that a period of rate normalization is approaching. In other words, while rates should remain relatively low over the long term, and the rate normalization process will be a slow one, the Fed is likely to begin raising rates in the first half of 2015, and the first rate hike could come as early as March, earlier than many market watchers expect. Rick Ryder covered a bit about what this means for the markets and the economy, but you may still be wondering how to position your portfolio for normalizing rates. Treasury bonds with 2 to 5 year maturities. While longer-term interest rates have remained stable, the prospect for an early Fed tightening is exerting downward pressure on the prices of shorter maturity Treasury bonds, particularly those with 2 to 5 year maturities, and pushing yields higher. I continue to advocate caution towards these maturities, as I expect they will prove the most vulnerable in the Fed's does in fact accelerate the timeline of the first rate hike. Commodities like gold. In addition to short maturity bonds, another asset class that is providing vulnerable to rising rates is commodities. The prospect of tighter monetary conditions is driving the dollar higher and putting downward pressure on many commodities. Stronger economic data and the prospect for tighter monetary conditions recently pushed the dollar to its highest level since last September. Along with a stronger dollar, the potential for higher real, i.e. inflation-adjusted rates, and a declining geopolitical risk premium have pushed the gold price down 5% from its July high. Other commodities, this might be a time to actually purchase gold, but of course you need to wait until the 52-week low. What you can't predict it, but getting close to it. Other commodities have suffered as well. Most agricultural commodities are down between 5% and 10% year to date, and oil prices have slid on less angst over Iraq and the Middle East. Among the various commodities, I remain particularly cautious over precious metals given their sensitivity to higher real rates. As for which asset class I would like, I continue to prefer stocks over the traditional safe haven assets I mentioned above. Why? Traditional safe haven assets such as short to intermediate duration U.S. Treasuries and gold may in fact be more vulnerable than stocks in the near term as the period of interest rate normalization approaches. Although not cheap, stocks have the tailwinds of still low rates and improving economic conditions at their back. The stock market continues to wrestle with a series of counter forces, and for now, low rates and an improving U.S. economy are trumping full valuation and lingering geopolitical risks allowing stocks to move higher. Now, this advice is only as good as your expertise in evaluating stocks. Is it overbought? Is it undersold? Is there volume to the stocks? Now, this is simply short term. I'm talking 6 months. That's the only thing that you can really look at as far as this is concerned. That's it for the Shigama Live Show. Thank you for watching.